Thank you. It's a pleasure to present here today, and I really appreciate this opportunity to contribute a practitioner's view to this conference on accountability in a sustainable world. The conference program looks excellent, and I look forward to listening to the presentations in due course. I will share some insights on how we advocate at the market level with regulators and standard setters for better and more standardized sustainability reporting. I will also shed some light on how we engage with our investee companies for better disclosure and the results we are observing. We believe that working at both the market level and with individual investee companies to encourage standardized reporting and its adoption is required to achieve change. Now, let me briefly introduce the fund. Norges Bank Investment Management is the asset manager of Norway's government pension fund. We have a very clear mission to safeguard and build financial wealth for future generations. The fund is owned by the Norwegian people. The Norwegian Ministry of Finance sets the overall investment strategy, and any major changes to this strategy require the approval of the Norwegian Parliament. The operational management of the fund has been assigned to Norges Bank Investment Management, part of the Norwegian Central Bank. At NBIM, our task is to achieve the highest possible return with moderate risk. Responsible investment is a priority in managing the fund. The fund was set up in the 1990s to support the Norwegian government's long-term management of petroleum revenue. The idea was simply to transform the value of the fund that we pump out of the North Sea into a financial fortune. So we take the oil out of the sea and invest it. Today, the fund is worth more than twice as much as the remaining petroleum wealth in the Norwegian continental shelf. It is the world's largest sovereign wealth fund with a market value of around 11,600 billion kroner, or circa $1.2 trillion. At the end of June this year, close to 69% were invested in equity, nearly 28% in fixed income, and the remainder in unlisted real estate and renewable infrastructure. We are invested in over 9,000 companies and own more than 1.4% of all shares globally. A few examples of companies we are a shareholder in are Apple, Nestlé, Tencent, well-known names. Given that we are so widely invested and have a very long investment horizon, we believe that a good long-term return for the fund depends on a sustainable economic and environmental and social development. It also depends on well-functioning, legitimate and efficient markets, and this belief drives our efforts to work for better market standards on sustainability reporting. We want to integrate sustainability information in all our ownership and investment decisions to understand our exposure to sustainability risk and opportunities, but to do that we need reliable and detailed reporting from companies. As one example, calculating our carbon footprint, that is the greenhouse gas emissions from the companies we invest in, allows us to better understand our exposure to climate transition risk. And you can see that our carbon footprint has declined over the last 2 years. This is, of course, in itself encouraging, but there is a lot of variation in terms of the quality and the frequency in which companies publish their so-called Scope 1 and Scope 2 emissions that this data is, or these analysis is based on. And the Scope 3 data, that is their value chain emissions, is even more challenging. To take into account sustainability information in our ownership and investment decisions, we simply need reliable data. And better and globally accepted standards are the key, I would say, to more reliable data. To support such developments, we contribute our views as a financial investor. In 2020, we published an asset manager perspective on corporate sustainability reporting. In it, we explain that investors need better information. We talk about the better information for risk exposure to determine whether a company is exposed to a specific sustainability issue, better information on the management of that risk to understand how companies manage their risks and opportunities, and finally, better information on performance, relevant, comparable, and reliable key performance indicators that use recognized calculation methodologies. Such information should be provided in a standardized way based on globally accepted and financially material metrics. And we also believe that to ensure that the disclosed information is accurate, sustainability disclosures should receive board sign-off similar to financial disclosures. We have engaged with international standard setters and regulators in our main markets to share our perspectives and encourage more standardized sustainability reporting. We contribute our expertise to initiatives, for example, by being a leading voice on the SASB Investor Advisory Group, taking the vice chair role. We also frequently contribute to public consultations. One example is our response to the SEC consultation on climate change disclosures last year. We welcome the proposal to build on the TCFD recommendations. We also emphasize that it would be helpful if the Commission were to allow foreign private issues to use the IFRS climate-related disclosure standard to meet their climate reporting obligations. Enhanced and standardized disclosures are welcome, and especially at a global scale. We are pleased to see that our efforts, and by many of the efforts of us and many other investors, seem to be paying off. We are excited about the creation of the IASB and the consolidation of voluntary standards. The IASB is creating a global baseline for financially material sustainability reporting. This is a big step forward towards more reliable and comparable global disclosures. We also observe more national authorities asking companies to report this information. This is a great starting point. We encourage standard setters to set mandatory requirements, and we believe that this will be the most effective way to achieve what we need: improved standardized and global disclosure regulation on all financially material topics. So we work hard at this market level for improved standards for the companies we invest in around the world. But of course, we also engage directly for improvement and change with our 9,000 investee companies. On the sustainability topics, we do this on the back of 9 expectation documents developed over the last 15 years. These expectations form the basis of our dialogue with companies. They give us a principled basis and predictability as investor, and public expectations allow us to reach out to companies at scale. Our expectations are based on international standards such as the OECD guidelines for multinational enterprises and the principles for corporate governance. As shareholders, the boards are our most relevant counterparty. We care about the well-functioning of boards and that the board's role in the governance of companies is clear, and our expectations are therefore primarily directed at company boards. We expect boards to take the overall responsibility for company strategy, and that also includes addressing challenges and opportunities posed by environmental and social issues. And it means that the board should integrate material risks in these areas into the company strategy, risk management, and also in its reporting. Because reporting and better disclosures are key asks in our expectations and in our dialogues. We are investors, we live on information. Our job is to understand the companies and their value creation. We also need to understand trends over time and between companies. As a starting point, we believe that the companies should consider the industry-specific metrics of SASB, soon ISSB, and base broader disclosures on the GRI standards. We convey our expectations by meeting directly with the boards and senior management of our investee companies. We held over 1,000 meetings where we discussed ESG in the first half of 2022 alone. The graph here shows you which topics we covered. As you can tell by the distribution, climate change is a strategic challenge we engaged a lot on. In fact, we had climate meetings with companies representing 22% of the net asset value of our equity investments, or some $150 billion. Other topics loom large too: core corporate governance issues as capital management and effective boards, and human capital management at the core of a modern company's value creation, and one of the rising topics as a share of our dialogue. In fact, we just released a new expectation document on human capital management to articulate our views even more clearly. And of course, many of these topics are linked, and we would like to see the companies manage these risks and opportunities in a strategic, integrated, and coherent manner. In addition to dialogues, voting is a powerful tool to convey our views. This year looks likely to break records for shareholder proposals on sustainability disclosure. We assess such proposals based on a framework of materiality, prescriptiveness, and the company's context and response. But we also look at companies where we believe the response is lagging in itself, and may then ultimately decide to hold the board to account. Recently, we have increased our votes against the board where companies targets and disclosures of climate and other sustainability risks are insufficient. This slide shows some examples of companies without adequate climate disclosures, transition plans, or emission targets. With companies in sectors where transition risks are material, we believe the board should ensure reporting that enables investors to understand the company's management of such risks. For us to be a considered and effective shareholder, we need detailed information to prioritize companies for engagement. And to track progress in company practices, we regularly assess companies against indicators to measure governance, strategies, risk management, and targets. In 2021, we did 4,196, to be precise, assessments and collected over 160,000 data points. We are very pleased to see that our advocacy at market level, engagement and voting appear to show results and that we see indications of improved disclosure. Across 7 of the 8 categories, scores improved, and we are seeing the best disclosures on climate change. Of course, these results reflect improvements and relative maturity of standards and approaches in this area, far beyond our activities alone. However, when we look into the change in assessment scores for the companies we engaged with, we see that the average improvement is 12 percentage points against 5 percentage points for companies we didn't engage with. That is encouraging too. So let's look again at climate to see how disclosure improved on the chosen indicators. We have seen significant progress on disclosure across most of the 10 key indicators. We have limited this sample that you see here to companies that were owned and assessed in all 3 years to ensure that results are comparable over time. And you see that an increasing share of companies report that they use an internal price on carbon, and we see a notable progress in disclosure of company emissions, including value chains, scope 3. We also see that disclosures are gradually more aligned with the TCFD framework. This is information we need to understand risks and opportunities. And remember, these are fairly new concepts and a step change on where we were just a few years ago. Then you have those things that didn't even exist some years ago. Progress on setting and disclosing science-based targets aligned with the goals of the Paris Agreement has been encouraging, but the share of companies reporting such targets remains low. Setting science-based targets will be particularly important on the road to net zero and in our engagement with companies. This is even more true for some sectors. You may remember from the earlier slides that our carbon footprint is concentrated in certain sectors such as basic materials and industrials. These are naturally companies we are focused on in our engagements. Here you can see that disclosures in these 2 sectors also improved. Particularly impressive is basic materials, where in 2021, 45% more companies disclosed climate transition plans and 44% more reported in line with the TCFD requirements. So a rapid change. And although scope 1 and 2 disclosures almost reach 100%, transition plans and TCFD disclosure remain the 2 categories where we want to see further improvement. So to conclude, we believe that we have a meaningful role to play, both at market level and with companies. We see some encouraging results, and we see that ownership works. But one swallow does not make a summer, and we need more complete and consistent information to support our risk and investment analysis. We also still need more standardized sustainability reporting and actively support the initiatives, such as the IISB, to get us there. Market change is our preferred option. That's how we raise the bar for all companies. And that's why we engaged for the adoption of improved standards with regulators and investee companies. And of course, there is still some way to go before sustainability disclosures are fully integrated in financial reporting. More so, disclosures are one thing. We also need to see actual results in terms of improved performance. Thank you very much.
Wilhelm, your presentation shows your influence through ownership is yielding results, and corporate reporting on sustainability is improving. What do you see as the important next steps?
That's a great question, Peter. And I think the answer is in equal parts straightforward and challenging. Let's do the straightforward bit first. I don't think we or the standard setters or companies need to reinvent the wheel. The foundation for good sustainability reporting are already there. The frameworks and standards are clear and well-founded. Developments over the last few years are impressive. So it's more about putting the concepts into practice through new disclosure rules that drive company adoption and achieving the coherent and consistent reporting on material sustainability information that better enables us as investors to assess risks and opportunities, to support long-term value creation and ultimately markets to perform better. For us and the companies, this is about demonstrating not only that they are on top of the risks, but also their progress over time. And that brings me, I think, to the challenging bit. That this new, the forward-looking performance metrics that we need. Net zero targets, for example. This area is less advanced and goes beyond the traditional materiality approach, if you will, to approaching sustainability reporting. Net zero transition plans and targets need to be evaluated depending on progress. They are performance measures. We need a better understanding of emission pathways, abatement costs and opportunities, and ultimately for the concept to be meaningful, a policy environment that over time fulfills the global climate commitments and the goals of the Paris Agreement. Nevertheless, this is the most pressing sustainability risk markets and companies face. We invest globally and for future generations. Climate risks are more than anything a macro risk for us, a risk to future global growth. And to reduce this risk, emissions need to come down. Our fund benefits from an orderly transition to a net zero economy, and we want to be an effective owner through that transition, and we want to be able to assess companies and ultimately report on our own efforts in getting us there. And until we as investors can compare and contrast net zero targets, their strengths and their weaknesses, the performance of companies and potential future trajectories, we are simply flying blind in this area. The extent to which targets are fulfilled should become robust performance measures specific to industries. So expect us to be a particularly active participant in the development of net zero reporting standards. And to do that, we aim to collaborate closely with academia, with civil society, and with our investee companies.